Welcome to the Deep Dive. Today we're digging into Wipro's Q2 FY26 earnings.
That's right.
Our mission is really to understand how these huge deal wins stack up against, well, frankly, some pretty cautious guidance for Q3.
It's a fascinating picture, isn't it? Strong signals in the source material, but yeah, that guidance definitely raises questions.
Yeah.
Let's jump right into the core numbers for the quarter ending September 30th.
Okay, the scorecard.
Yeah.
So IT services revenue, $2,604.3 million.
Yep. And sequentially, that was up 0.3% in constant currency.
Which was within their guided range, so stable there.
Stable, yes, but year over year, it's actually a decline. Revenue dropped 2.6% year over year in constant currency terms.
Okay, so a mixed picture on revenue, but what about profitability?
That's where things look a bit brighter. Net income grew 1.2% year over year, and EPS was up 1.0%. Critically, operating cash flows were really strong.
How strong?
103.8% of net income. I mean, they're generating cash very effectively.
Right, okay, so if cash flow's good, net income is up. That brings us to the Q3 outlook. Why does it feel so reserved?
Exactly. For the next quarter, ending December 31st, they're projecting revenue between $2,591 million and $2,644 million.
Which translates to, what, minus 0.5% to plus 1.5% sequential growth in constant currency.
Precisely. So the midpoint is only about, 0.5% growth.
And that doesn't even include any potential revenue from that Harman DTS acquisition they announced.
Correct. They explicitly excluded that. So it is a notably conservative forecast, especially, as you said, when you look at the deal bookings they just reported.
So why? What's the thinking behind playing it so safe when they've just signed all this new business?
Well, I think the story of Q2 wasn't really about the revenue they booked in the quarter itself, but about the future revenue they secured. Total bookings hit $4.7 billion.
Which is a big number.
It is. But the real headline grabber is that the large deal bookings deals over $30 million. They came in at an incredible $2.9 billion.
Wow. Okay, $2.9 billion in large deals alone. How does that compare?
It's massive. That's a 90.5% increase year over year in constant currency. 90%.
Just staggering growth in large deals.
It really tells you something about the market's appetite, doesn't it? And get this. The large deal bookings, just in the first half of this fiscal year, FY26, have already beaten the total large deal bookings for the entire previous year, FY25.
The whole year.
Whole year. They signed 30 large deals in Q2, including 2 huge mega deals, one in healthcare, one in BFSI.
Banking, financial services, insurance, that's a core area for them.
Absolutely. So the demand is clearly there. Clients are signing on the dotted line.
Okay, so if the deals are flooding in, where are we seeing the immediate impact? Which regions, or SMUs as they call them, are actually growing right now?
We saw sequential growth in 3 of the 4 main geographic units. Europe did well, up 1.4% sequentially in constant currency, driven a lot by BFSI.
Okay.
APMEA, that's Asia Pacific, Middle East. Africa was actually the strongest performer, grew 3.1% sequentially. That was mainly India, Australia, Southeast Asia.
Right.
And Americas 1 also grew 0.5% sequentially, mostly healthcare, tech, and communications driving that.
So 3 out of 4 growing. Which one was the drag?
That would be Americas 2. It declined 2.0% sequentially.
Any explanation for that?
Yeah, management seemed pretty confident about its future growth. They said deals won earlier in the fiscal year are just starting to ramp up now, so they expect that to turn around. And, we have that specific example in Europe.
The Phoenix deal?
Exactly. They specifically mentioned the Phoenix deal is set to start contributing revenue in Q3, so you see that lag effect.
Okay, that makes sense. What about sectors? We mentioned BFSI was strong in Europe.
Yeah, BFSI was a clear leader overall, up 2.2% sequentially. Technology and communications also grew about 0.8%. It really looks like those sectors are jumping on this vendor consolidation and AI transformation wave first.
But some sectors struggled.
Yes. Consumer was down 1.7%, and EMR, energy, manufacturing, and resources was down 1.5%.
Any reason given for the dip there?
They attributed it mainly to clients pausing some big transformation projects like complex SAP rollouts. Seems tariff uncertainties globally are making companies rethink their supply chains and maybe hold off on those huge spends for a bit.
Which brings us neatly to strategy. If some traditional areas are slowing, what's driving that $4.7 billion in new bookings? It has to be something specific.
Absolutely. The demand surge seems largely fueled by clients needing, cost optimization, wanting fewer vendors to manage that vendor consolidation, and crucially, needing these AI-powered transformations.
And Wipro's big answer to that is Wipro Intelligence, right?
That's the one. It's their umbrella brand. A unified suite bringing together their AI platforms, specific solutions, and transformation services.
And the goal.
Essentially, to help clients adopt and scale AI confidently, to really lead in what they're calling an AI-first world. It sounds like more than just talk. They're embedding AI deep into their delivery, their consulting, everything.
It also sounds like they're getting very specific, not just offering generic AI tools.
Exactly right. They actually called out 3 named industry-specific solutions, which I think is telling.
Which ones?
AutoCortex for automotive, Wealth AI for BFSI, and Pay AI for healthcare. That level of tailoring suggests they're really targeting specific business problems with focused platforms. It's way beyond just, generic generative AI chat.
And we saw some real-world examples of this in action. There was that UK financial company deal.
Yeah, that's a great example of deep transformation. They're using Wipro's Vega AI platform to basically overhaul back office operations. We're talking HR, mortgages, even financial crime prevention. It's AI doing heavy lifting on core processes.
That's significant. And there was another one, the Agentic AI framework, also for a UK financial firm.
Right, that one was about tackling payment data. The client needed better, faster intelligence. So this agentic AI framework analyzes the payment stream, creates dashboards, predicts trends, and importantly, flags potential fraud in real time. It's moving from AI advising to AI actively doing.
But when you embed AI that deeply, especially in finance, the risks must be huge. What about things like AI making mistakes or hallucinations or data security?
They address that head on. They stress the importance of the responsible AI guardrails they've built into platforms like Vega and Wings.
Guardrails.
Yeah, features designed to manage risks like hallucinations, bias, ensuring fairness. And crucially, they said this isn't just a feature, it becomes part of the contract with the client. That offers reassurance needed for large-scale adoption.
Okay, that makes sense. Let's shift then to the money side, the margin reality. We've got these massive deals, AI transformation. But what does it mean for profitability right now?
It's complex. The reported operating margin for Q2 was 16.7%.
Which seems a bit lower than maybe expected.
Well, yes, but that number was dragged down by a specific one-off hit. They had to make a provision of $13.1 million because a client went bankrupt.
Ouch. Okay, so if you adjust for that.
If you adjust for that one-off item, the underlying operating margin was actually 17.2%.
17.2%. And how does that compare?
That's actually up 0.4% year over year, and it puts them right in that narrow 17.0% to 17.5% band they've sort of signaled they're comfortable with.
Right. But wait, if they're winning these huge vendor consolidation deals, I thought those could sometimes hurt margins initially.
They absolutely can. That's a key part of this tension we're seeing. These large consolidation deals are, as they put it, intensely fought.
Meaning competitive pricing.
Exactly. Very competitive. So they often start out being margin dilutive. Wipro has to invest significantly upfront, transitioning services, integrating systems, staffing up.
So like an investment phase for each big deal. Short-term cost for long-term benefit?
Precisely. You make the upfront investment to win the massive contract, and then profitability improves over time as you streamline things, find efficiencies, and productivity ramps up over, potentially years.
Okay. Are there other pressures on the margin we should know about, particularly looking at Q3?
Yeah, a couple of things. First, Q3 is always seasonally a bit weaker for IT services. Fewer working days because of holidays, furloughs, that kind of thing.
Right, the holiday quarter.
And second, that Harman DTS acquisition, whenever it closes, is expected to dilute margins by about 60 basis points initially. Integration costs, restructuring, etc.
So with those pressures, initial dilution, seasonality, the upcoming acquisition, how are they keeping the adjusted margin up at 17.2%? What's working well internally?
They're pulling the efficiency levers hard. Net utilization, basically, how many consultants are busy on projects, is up significantly to 86.4%. That helps a lot.
Fewer people on the bench.
Right. And attrition, staff turnover, has dropped quite a bit. TTM voluntary attrition is down to 14.9%. That saves a ton on recruitment and training costs. They also mentioned better profitability on fixed price projects.
Okay, so it comes back to this timing gap, doesn't it? Massive deal signed, but conservative guidance because it takes time for that revenue to actually flow through.
That's exactly it. Management was clear. These big deals, especially the BFSI ones or those with a big net new component where they're building something from scratch, can take 6 to 8 quarters to fully ramp up to peak revenue.
6 to 8 quarters, that's 1.5 to 2 years.
Yeah. So they're not chasing quick quarterly wins. They're building a very large, long-term book of business, that recurring annuity revenue.
So, summing it all up, Wipro is leading with AI, winning huge consolidation deals, growing the backlog massively, but they're keeping Q3 guidance tight. It's a strategic choice.
It absolutely looks like one. They are clearly prioritizing capturing these long-term, multi-year AI-driven transformation contracts above maximizing near-term revenue growth or pushing margins higher right now.
They're accepting that initial margin hit, the slower conversion cycle.
To secure that future market share in the AI transformation space, it's a long game they're playing.
A trade-off.
Yeah.
Near-term pain, or at least less impressive numbers, for potentially massive long-term gain.
That's the heart of it, and it leaves us with a key question, doesn't it? We've seen these incredible large deal numbers, TTM bookings already ahead of last year, just halfway through this year. But since these deals take, say, 6 to 8 quarters to ramp,
Yeah.
how much higher do those TTM large deal bookings need to climb before we see Wipro consistently guiding sequential revenue growth above that, say, 1.5% mark? When does the sheer volume of secured future revenue finally start pushing the immediate quarterly outlook higher? That's the inflection point everyone will be watching.